Welcome to Chapter 1 of Accounting 231. We start with a simple question. What kind of cost is each input? That question sounds basic, but it is the foundation for everything that comes next. If you can classify a dollar correctly, you can understand what a product really costs, what to trace, and what to treat as overhead. As you work through your own team product this semester, keep that question in mind. By the end, the labels should feel natural, not memorized, and the rest of the chapter will make a lot more sense. Let's build the vocabulary together. You already made something and filmed it, so the costs are real. Ingredients, time, tools, workspace, they all show up in the production process. Chapter 1 gives us 3 lenses for sorting those costs. First, what is the cost? Direct materials, direct labor, or overhead? Second, how does it move when volume changes, variable, fixed, or mixed? Third, where does it end up? Product cost or period cost? Once you have those 3 lenses, the rest of managerial accounting becomes much easier to follow. Think of financial accounting and managerial accounting as 2 answers to 2 different audiences. Financial accounting speaks to outsiders like investors, lenders, and regulators, so it follows GAAP and focuses on the whole company and what already happened. Managerial accounting speaks to insiders, managers, supervisors, team leads, so it can use whatever format helps decision-making. It can zoom in on one product, one department, or even one batch. That flexibility is exactly why we use it here. We are not just reporting costs, we are using them to make better decisions. Before we classify anything, we have to decide what we are costing. That thing is called the cost object, simply the specific item or activity whose cost we want to measure. It could be a batch of cookies, a patient visit, a flight route, or a department. For this class, the cost object is one batch of your team's product. That choice matters because it determines what counts as direct and what counts as indirect. So keep asking, what is the cost object and what costs belong to it? Once the cost object is set, every cost falls into one of 2 buckets, direct or indirect. A direct cost can be traced to the batch, like flour going into those cookies, or the hours you spent mixing them. An indirect cost supports production but cannot be economically traced to one batch, like oven rental, electricity, or cleaning supplies. The key question is simple: can I trace this cost to my batch? If yes, it is direct. If not, it is indirect, and it will need to be allocated later. Manufacturing costs break into 3 categories. Direct materials are the raw inputs that become part of the product and can be traced to it. Direct labor is the hands-on work that makes the product, measured by traceable time at the wage rate. Manufacturing overhead is everything else in the factory: rent, utilities, indirect materials, and indirect labor. Those 3 buckets show up again and again in this course, so it is worth learning them early. If you can sort the cookie ingredients, labor, and support costs, you are already thinking like a manager. Direct materials are the ingredients that actually become part of the cookie or part of your team product. Flour, butter, sugar, and chocolate chips all count because you can measure them, trace them to the batch, and record them at the actual purchase price. The test is simple. Can you conveniently and economically trace it to the product? If yes, it's direct material. If not, like parchment paper or cooking spray, it's indirect material, and it goes to manufacturing overhead. Direct labor is the time you spend with your hands on the product, mixing, shaping, packaging, or in the cookie example, mixing, portioning, and baking. In a factory, that would be the assembly line workers' wages. In your project, it is your time. We calculate it as hours worked times the Washington minimum wage. For 2026, that rate is $17.30 per hour. So if you spend 45 minutes or 0.75 hours making a batch, direct labor is 0.75 times 17.113, which is $12.85. We'll lock in that rate at milestone 2. Manufacturing overhead is the catch-all for every manufacturing cost that is not direct material or direct labor. Think of it as the cost of having a factory, even if your factory is your kitchen. In this course, equipment rental is a big one. Every tool is treated as rented at 10% of its purchase price per month, so a $300 oven becomes $30 a month in overhead. Utilities, indirect materials, and indirect labor all belong here too, because you can't trace them to one batch. These two groupings are shortcuts that help you think about manufacturing costs. Prime cost is direct materials plus direct labor, so it captures the costs most directly traceable to the product. Conversion cost is direct labor plus manufacturing overhead, so it captures the cost of turning raw inputs into a finished product. Notice that direct labor shows up in both. That's not a mistake. It's the bridge between raw materials and the finished item. Here is the distinction that connects cost accounting to the financial statements. Product costs, direct materials, direct labor, and manufacturing overhead attached to the product. They sit on the balance sheet as inventory until the unit is sold. Only then do they become cost of goods sold on the income statement. Period costs, selling and administrative expenses, are expensed immediately when incurred. They never sit in inventory. Think of it this way. Product costs follow the product, while period costs follow the clock. So factory depreciation is a product cost because it is manufacturing overhead, but the sales manager's salary is a period cost. Outside of manufacturing, the big period costs split into two groups. Selling costs are the costs to get the order and deliver the product. Advertising, sales commissions, shipping, and even a farmer's market booth fee or Instagram ad. Administrative costs are the costs to run the organization. Executive salaries, office rent, accounting fees, and legal costs. For your project, you probably won't have many of these yet because right now you're focused on making the product, not marketing it. That changes later in Chapter 6. Now we switch to the second lens, cost behavior. Instead of asking what the cost is, we ask how it changes when volume changes. That gives us 3 labels to watch for: variable, fixed, and mixed. The key idea is that the same cost can sit in more than one category at once. Flour can be direct material and also variable. Equipment rental can be manufacturing overhead and fixed. So we are not putting costs in separate bins here. We are just looking at the same cost through a different lens. Variable costs are the easiest place to start because the pattern is so clean. In total, they change in direct proportion to activity, but on a per unit basis, they stay the same. If flour costs 50 cents per batch, then 10 batches cost $5 and 20 batches cost $10. The total goes up as volume goes up, but the batch cost stays at 50 cents. That is why most direct materials and direct labor costs are variable. The more you make, the more you use. Fixed costs are the mirror image. In total, they stay the same no matter how many batches you make, but the cost per unit falls as volume rises. If oven rental is $30 a month, then 10 batches carry $3 of oven cost each, while 30 batches carry only $1 each. That spreading effect is economies of scale. Textbooks also separate committed fixed costs, like a long-term lease, from discretionary fixed costs, like an annual training budget. For your project, equipment rental is usually committed for the semester. Some costs have both a fixed part and a variable part, and that is what mixed costs are. Think of an electricity bill with a $15 monthly charge plus 10 cents for each kilowatt hour used. The formula is Y equals A plus BX, where Y is total cost, A is the fixed portion, B is the variable rate per unit, and X is activity level. If you use 200 kilowatt hours, the total is $35. In real companies, mixed costs are common, but for your project, most costs will still look clearly variable or clearly fixed. One caution: the usual rules for variable and fixed costs only work within the relevant range. That is the normal operating band where your assumptions hold. Outside it, the pattern can break. Buy 1,000 pounds of flour and you may get a bulk discount, so the per unit cost drops. Push production to 500 batches a month, and one oven may not be enough, so you rent a second oven and fixed cost jumps. For your project, the relevant range is probably somewhere inside your normal batch volume, where the math is useful and realistic. Before we move on, here are 3 cost ideas that matter most when you make decisions. Differential cost is the difference between 2 alternatives, like $40 at home versus $70 in a commercial kitchen. Opportunity cost is the benefit you give up, such as time you could have spent earning $17.13 an hour somewhere else. Sunk cost is already spent and cannot be recovered, like flour you already bought. For decisions, the big rule is simple. Focus on what changes and ignore sunk costs. Before we leave the cookie kitchen, let's apply the same ideas to a company you already know. Apple. The iPhone is a huge product line with more than 200 million units sold a year and more than half of Apple's revenue tied to it. The question is not just whether it is profitable, it is how to classify the costs behind that profit. We'll use the same 3 lenses you'll use on your own product: what the cost is, how it behaves, and where it goes. And yes, every number here comes from public sources. Start with the manufacturing cost. Apple's iPhone 16 Pro Max sells for $199, and it costs about $485 to manufacture. Direct materials make up most of that: the OLED display, rear camera module, A18 Pro chip, battery, storage, and other components. Direct labor is about $30 per unit for assembly. Everything else in the plant, depreciation, utilities, quality control, supervisors, is manufacturing overhead. Then come period costs: advertising, Apple Store wages, shipping, and administrative costs like legal, accounting, and headquarters. R&D is expensed as incurred, so it is a period cost too. Now look at the second lens: cost behavior. Apple's variable cost is about $485 per iPhone because components and assembly rise with each unit shipped. Sell 200 million phones and variable cost is about $97 billion. Sell 220 million and it rises to about $107 billion. The per unit cost stays close to $485. Fixed costs are different. Apple spends about $57 billion a year on R&D and SG&A, whether it sells 200 million iPhones or 220 million. That is why volume matters so much. Once fixed costs are covered, extra units add a lot of profit. Put the pieces together and the margin story gets clearer. Apple sells the iPhone 16 Pro Max for $199 and spends about $485 to build it, so gross margin is roughly 60%. But the bigger lever is fixed cost spread. At 200 million units, Apple's $57 billion in fixed costs works out to about $285 per phone. At 220 million, it drops to $259. That $26 difference times 220 million phones is about $5.7 billion in extra profit with no extra investment. Your project works the same way. Fixed equipment gets cheaper per batch, while ingredients stay variable. Here is your milestone 1. A memo and a presentation, both due Tuesday, September 3rd. First, list every input in your product. Then classify each one 3 ways: DM, DL, or MOH, variable or fixed, product or period. Next, write 1 or 2 sentences about what surprised you, especially what was harder to classify than you expected. Finally, state the bottom line. What does your classification tell you about where the money goes? In class, you will present live, show your production video, and walk us through your costs. This is checklist graded, so do the work and earn the points. Chapter 1 gives you the vocabulary to name every cost before you start adding numbers. First lens. What is it? Direct material, direct labor, or manufacturing overhead? The key question is traceability. Second, how does it move? Variable, fixed, or mixed? Third, where does it go? Product costs flow into inventory and then cost of goods sold, while period costs are expensed right away. Next up is Chapter 2. What did one batch cost? That is job order costing, and it is where your production tracker comes to life. See you there.